What is up, everybody? Dan again, stocktrades.ca. Welcome back to the channel. In this week's video, I'm going to be going in a bit of a different direction. I've been typically focusing on ETFs a lot on the channel over the last while, but this has been a very heavily demanded video from our readers, from our watchers, and that is to cover a very popular stock here in Canada and one that is really struggling right now, and that is BCE, or what a lot of people know it as Bell Mobility, or just Bell. The company, since issuing its 2024 guidance, has taken a very sharp turn downwards, and this is typically a very low volatility stock that is trading something like 40+% off its highs from just a few years ago. So we're going to dive into the company, mostly focusing around their 2024 guidance and the impact on the dividend. This is the most important thing because this is a stock that a lot of income investors own, and a lot of income investors rely on that dividend. Is the dividend in danger? I would say on a very surface level, yes, it is when you look at the sheer numbers, but we're going to dive into it right now in this video. Again, everyone, head down below, like the video, subscribe to the channel, and comment down below. If you like the stock-based video I'm going over today, you got to let me know, because I will cover more stocks if possible and do maybe a blend of stocks and ETFs. And again, we're launching a huge ETF initiative over at Stock Trades in the next bit here. So you're going to want to head down below and join the No BS newsletter. It's an absolutely free newsletter. 2 times a week, we're delivering rock solid information to over 25,000 Canadians, and you're going to get filled in on what exactly we're going to be offering in the next short bit here when it comes to exchange traded funds. But with that said, let's dive right into BCE. So full disclosure, I do not own BCE. I own TELUS. I believe that the businesses that TELUS is investing in and growing are faster growing, more modern businesses, while BCE typically relies on, lower margin media type businesses. I mean, we saw in their most recent quarter, they ended up selling off a lot of, radio stations. Typically, they are a bit more legacy assets, and I think that's really impacting the growth as of late. But when we look to BCE from a long-standing return basis, I mean, it's definitely no slouch. We go to max returns. If you had bought this company in the mid-90s, you would be sitting on, a 1,000% return. I mean, it's been a very strong performer, but the recent increase in policy rates is hitting this company hard, and I'm going to go over that in a bit. But when we look to its price over the last, even 3 years, we're looking at a total return. So this means you would have had to reinvest the dividends of negative 7.6%, while the TSX 60 has returned around 25%, 24.5%. When we look towards something like the S&P 500, or even a dividend fund, if you want to compare it to that, to like SCHD or something like that relative to the US market, it's not even going to come close in terms of total returns. And the primary reason for this is the bulk of it has been their issued 2024 guidance. I mean, when we look to early January, this stock has fallen quite a bit year to date. We're seeing it's down 12.54%. And, at one point, it was up nearly 8%. The 2024 guidance was a shock to a lot of investors, especially when we consider the fact that many of these telecoms, when rates were low, especially during the pandemic, there was a lot of capital expenditures. They have to take advantage of lower borrowing rates because these are very capital intensive businesses. They require a lot of capital to expand their infrastructure. And overall, this is not a, capital light business. So in a post-financial crisis environment, these companies took out a ton of debt to finance growth, and it worked very well. But now it's kind of falling apart when we're sitting here at 5% policy rates, and especially with the idea that policy rates are not going to come downwards materially anytime soon, just because of how well the US overall is operating at even a 5% policy rate. So when we look to just the overall price of BCE, we can see that in April of 2022, it hit peaks of, $75 around there, and now we're all the way down to $44. Now, what started happening in April of 2022? Well, policy rates started rising. So to give you an idea of what has caused the large scale pressures from here, from late January when it was, $55 a share down to 44 today, we have to go over their 2024 financial outlook. Now, this is absolutely key because dividend coverage has been lacking from all the telecoms over the last while. But again, lower policy rates, they're primarily focusing on, spending capital when it's cheap. A lot of investors assume these companies can scale it back. And as a result, free cash flow will improve. The dividend will be covered and they can, get back to a healthier dividend coverage ratio, I would say. So revenue and adjusted EBITDA outlook, we can see that 2023 revenues came in around $24.5 billion. And in 2024, they're expecting them to either be flat or grow around 4%. This is not the best growth rate, especially when we're sitting here, right now with a 3% inflation rate. I think CPI just came out this morning, 2.9%. So this is on a real basis, either a declining revenue growth rate or at best a flat growth rate. And of course, I just want to disclose as well, this is just guidance. The company could come above this, they could come below this. This is simply their 2024 outlook. When we look to their adjusted EBITDA, again, we're looking at 1.5 to 4.5% growth. On a real basis, this is really not that much. It's essentially flat. So their media department, it's being impacted by ongoing advertising recession. Advertising popularity is certainly not as popular right now as it was in the pandemic. And again, this company does have a lot of exposure to media assets, some of which it's been selling down over the last while, which has created, a lot of controversy. Bell's layoffs are going through the biggest restructuring they've arguably ever had, at least in the last 3-4 decades. And as a result, this is even it's got the government involved, suggesting that the layoffs were a bit over the top, but this company is having to scale back significantly to pretty much, try to maintain or at least increase cash flow. But overall, from the, top line perspective, the outlook is pretty murky. I don't think people expected this company to grow that fast, but a 0 to 4% increase is certainly not what investors were expecting. So when we go down to adjusted earnings per share, they're expecting a 7% to 2% decline in earnings per share. So we're looking at $3.21 in earnings per share in 2023, and we're looking at $2.98 to $3.13 in 2024. Off the top of my head, this company pays out a $4 dividend. I think it might even be $3.99. So you can see here from an earnings coverage ratio, this dividend next year is not going to be covered on an earnings basis. However, dividends in relation to earnings per share when it comes to telecoms are not the best way to judge it. They have a lot of depreciation, a lot of amortization on the income statement, which is added back to the cash flow statement because they're not necessarily cash expenses in that year. So free cash flow is going to be the much better gauge of dividend safety. But we can see here they're seeing a $200 million increase in interest expenses. This reflects higher outstanding debt levels and higher rates. So when we come down to free cash flow outlook, this is going to be the most important thing and is quite possibly the most important thing from that guidance in relation to, as to why BCE is struggling in terms of share price so much since this issue. So we can see that free cash flows were $3.14 billion in 2023. And when we take a quick look at their cash flow statement, and we can head down below to dividends paid. So total common dividends paid of $3.486 billion. So the company did not cover the dividend in relation to free cash flow in 2023. This was relatively expected. The company was expected to scale back capital expenditures in 2024, which would ultimately help that dividend coverage ratio. And when we look to the actual free cash flow outlook of 2024, they expect a 11% decline on the bottom end and a 3% decline on the top end. So the company is not only cutting capital expenditures, but its free cash flow is declining. So when we look to the top end of guidance at $3.05 billion in free cash flows, we can see that this company has around 912 million in shares outstanding. So we can calculate essentially $3 billion in free cash flows divided by 912 million shares outstanding. We can see free cash flow per share of $3.34. This company at this time pays a dividend of around 99 cents per quarter, 99.7 cents per quarter. So if we multiply that by 4, we can see a dividend of $3.99. So this would be a 65-cent shortfall in relation to the dividend at the top end of guidance. When we multiply this by the 912 million in shares outstanding, we can see that this company is going to come in short of the dividend by just under $600 million in 2024. Now, the overall outlook for this company was to actually cover the dividend in 2024, but as we can see, they've not only cut capital expenditures, they've done what many expected them to do, but they still expect free cash flows to decline. Now, there's a lot of pressures on this company right now in relation to interest rates. We can see right now, they said there's going to be a $300 million increase in interest paid driven by higher rates and higher average debt levels. So overall, higher policy rates are definitely impacting this company. So the one thing, this company is going to paint a picture that the operations are just fine right now. And as you can see, underlying free cash flow generation supports a 3.1% dividend increase for 2024. This is a bit puzzling to me. Their coverage ratios are going to be less in 2023 than they are going to be in 2024. And I know a lot of investors will kind of counter this, well, in 2025, it's going to be better. But the thing that's a bit difficult for me to understand here is in 2023, they said that the outlook in 2024 was going to be better. We have to understand that these are forward-looking outlooks that the company is issuing, and they do not always hit those outlooks, and the situation is not always as crystal clear as it seems. This company was supposed to improve free cash flow in 2024, and as of right now, we're looking at a double-digit decline on a free cash flow basis from 2023. So this free cash flow outlook kind of took a lot of people by surprise, and as a result, the stock has been under a ton of pressure over the last bit. So when we look to the balance sheet and liquidity position, the company has $5.8 billion in available liquidity. That's really not that surprising. They're going to have a ton of liquidity. These companies have a ton of financing options that they can draw from, and their net debt leverage ratio in 2024 is expected to remain relatively stable. So this is ultimately a benefit. They don't foresee the situation getting much worse. And when we look to their overall maturity schedule, it's kind of been a good thing moving forward with rising policy rates, but it's also going to mitigate the reduction in their interest expenses as rates go down. Ultimately, this company is in more trouble the longer rates stay high because there's going to be more maturities on its debt that they have to renew at higher rates. Now, when we look to the conference call transcript, we can see the company said our debt capital structure remains very well structured with an average time to maturity of approximately 12 years. So this likely means that they locked in a lot of their debt at lower rates, because actually when we go back to this outlook, we can see that the 18% floating interest rate is lower than the 20 to 30% historical targeted range. So they likely locked in some debt at more attractive rates. But the one thing that alarmed me in this, it says at these levels together with no material debt refinancing requirements until Q1 2025. This is kind of painted as if a lot of this debt is a long ways away from maturity, but we're in the second quarter of 2024. So material debt refinancing requirements in Q1 of 2025, that is not far away. That's 3 quarters away. And when we actually look to the balance sheet of BCE, we can see that the current portion of long-term debt for the company is at $3.771 billion. So this debt will either need to be paid off or refinanced within the next year. When we look to current portion, that means in the next 12 months. So when you look at a company's, cash on hand or cash equivalents, they go under current assets because that is assets that the company can turn into cash within the next 12 months. The current liabilities, on the other hand, are liabilities that are expected to come due in the next 12 months. So there is a bit of a refinancing risk here with BCE. When we look to overall total debt numbers, we can see that this company does carry, nearly $35 billion in debt. So $3.7 billion doesn't really seem like all that much, but again, it's just more pressure from a financing perspective. The cost of that debt is probably going to go up. So ultimately, their financing situation is not dire, but I wouldn't exactly call it optimal either. So, we've gone over flat growth, declining free cash flows. And I just want to comment on a very important element that a lot of investors, particularly Canadian income investors, have about telecom companies. A large misconception that they have about telecom companies is the fact that dividend coverage is not a huge issue because they can scale back capital expenditures to increase that payout ratio and ultimately have strong coverage ratios. But this just is not the case with the majority of telecoms. And I'm going to show you a very important chart here that is going to give you an idea of what I'm talking about. So this is pretty much a dividend coverage ratio of BCE dating back to the early 90s. So we can see here that there's actually very little situations where the dividend is not going to be covered. Now, this would be reported free cash flow per share on a quarterly basis. So this is why you see this really jagged chart. It's more accurate to depict it this way because of, it gives an accurate image of how much cash flows fluctuate, but it also gives an accurate image on the overall coverage of the dividend. So we can see that there was relatively strong coverage ratios leading up to the dot-com bubble. From there, the company didn't cover the dividend for, quite some time. We're looking at September 1998 to December of 2002. But since then, the company has had well enough free cash flow per share to cover the dividend. We can see very little instances where there hasn't been enough coverage on a quarterly basis. We're talking, maybe 5 or 6 quarters since the dot-com bubble. And when you look to the relation of free cash flows, they're much higher in those other quarters, which make up for these shortfalls. But if we fast forward to, where would it be here? We're looking at 2021. The company has not had enough free cash flow to cover the dividend since March of 2021. Now, this wouldn't have been a big issue for investors during this time. Again, high capital expenditures, that's perfectly normal for a company with typically, these capex cycles that are kind of off and on. They're going to spend more when debt is cheap. However, there should be some basis of a turnaround here in terms of coverage, and there simply hasn't been. We're looking at the company cutting capital expenditures in 2024, and they're still not going to be able to cover the dividend on the high end by, a bit, and on the low end by quite a bit. So this part right here, I think, is what is causing a large drawdown of the stock. And I understand the dividend is only one element, but again, this is pretty much, if you could call one stock in Canada a bond proxy, I would say BCE is definitely that. It is a stock that a lot of people, a lot of retirees, a lot of institutional funds hold this stock for the income. So the dividend is absolutely under a microscope. And despite the low outlook when it comes to free cash flows, the company raised the dividend, which was, I think it is a little bit here in order to maintain the reputation of a dividend growth stock. I mean, they did raise the dividend, but it was 3.1%. So on a real basis, you're effectively looking at flat dividend growth. As an income investor, if a company raises the dividend by 3.1% and inflation is, especially over the last year, you've actually lost purchasing power. So effectively, it's a raise, but it's not really a raise. But I believe the company would have actually been better off not raising the dividend and allocating capital to getting that debt reduced. So I'm going to dig into TELUS here to kind of highlight what I mean by this capital expenditures and how a lot of people expected CAPEX to cover the dividend for a lot of these telecoms in 2024. And if we head to TELUS's latest quarter, their Q4 2023, we can see that they returned around $2.1 billion in dividends to shareholders. And when we look to their total outlook, where is it here? Here we go. We can see that consolidated free cash flow is going to be approximately $2.3 billion. So they are going to be able to cover the dividend in 2024 if they hit this guidance, which is a huge difference from a company like BCE, who is actually expected to need to find capital elsewhere to cover the dividend. Free cash flow is truly the amount of cash on hand that a company has to cover the dividend. When free cash flow doesn't cover the dividend, they have to find it another way, whether that be equity, whether that be debt. But Either situation is not optimal for current shareholders. It doesn't really help you at all. I know a lot of investors, particularly in BCE, are just, the maintenance of the dividend at all costs because they want that yield. I think the yield is approaching, I think it's nearly 9% now, 8.78%. Investors are obsessed with the maintenance of this dividend because they want the income, but ultimately, a company having to acquire capital in other ways to pay this dividend, this isn't good for shareholders. I mean, I'm just going to be cut and dry there. It's not. And overall, we're looking at, trailing 12-month payout ratios in terms of earnings of 116% and cash flows 116%. This is trailing 12-month. Earnings are expected to decline. Free cash flows are expected to decline. So these ratios are going to go up. The company will not have enough money to pay the dividend in 2024. Now, with all that said, there tends to be a lot of negative sentiment towards stocks like this. There tends to be a lot of fear placed into it. And you can find bargains at this point with, severely declining stock prices. And when we go from a valuation basis, we can see that BCE is trading at 19.53 times trailing earnings, and we can see that its 5-year historical average is 20.41. So this company is really not trading at that much of a large discount. Now, on a free cash flow basis, it is. It's trading at 12.7x trailing free cash flows, and its historical average is around 16.05. But when we remember that free cash flows are expected to decline by 11%, on the low end of things, this free cash flow on a trailing basis, this ratio on a forward basis is, going to go up. So if we factor in, let's say, the absolute low end of free cash flows, $2.8 billion, we can see that the company is, a $40 billion market cap divided by 2.8. It's trading at around 14.5 billion expected free cash flows on the low end. So is there as much perceived value here as some investors seem to think? I don't think so. When we look at a market cap of 40.61 billion, in order to get back to its all-time highs, $73 per share around there, which I mean is a bit of a stretch upwards, but let's say what we would exactly need for BCE to get back to those $73 highs for investors who bought at the absolute peaks to make their money back, we would need a market cap of around $73 billion. And when we consider the fact that the company, let's take the low end of guidance again, $2.8 billion in free cash flow generation, we would need the company to trade at 26x expected free cash flows. There has been virtually no time in this company's history when it's ever commanded this type of valuation. I mean, when we look to 10-year historical free cash flows, we're looking at 17x. So for this company to return to that all-time high share price in the next, year or so, it would require significant multiple expansion and, a significant turnaround overall, in my opinion. The more likely result is the fact that this company actually has a bit of multiple contraction over the next while, because this 10-year median, again, is going to be based on a very low interest rate environment that we've witnessed over the last 10 years. Unless you believe that policy rates are going way, way down, I don't believe this company will command those types of valuations again. But the company does have a PEG ratio of 0.8, suggesting that there might be a bit of, bearish sentiment priced into this company. And in my opinion, a dividend cut priced into this company. There's very few times where a company all of a sudden starts to yield nearly double its historical average. I mean, we're talking 9% yield, whereas this company it typically doesn't yield anywhere near that. And typically you'll see this when, the market is pricing in either a lot of negative earnings moving forward or ultimately a dividend cut. We can even see, there's been certain instances where a dividend cut is so obvious. One situation would be, say, Ryokan from the COVID-19 pandemic, where the stock price actually goes up when the dividend is cut. In Ryokan's case, the distribution. So is there a bit of upside here if rates start to come down and the company gets a bit back on track? I would say yes, but in my opinion, I would not expect those, pandemic level highs. It would have to trade at either a crazy valuation multiple or it would have to significantly grow free cash flow. So what does BCE exactly need to happen in order to see a big recovery in their share price? I would say they need policy rates to come down, and they need to come down fast. And that is a very difficult element here because The United States is actually operating relatively well off 5% policy rates, which really paints a bad picture for super low rates coming back. Rates they're inevitably going to decline, but the true impact is ultimately going to be how much these rates are going to decline. And with the US economy seeming to be chugging along fine at a 5% policy rate, I'm not sure we're going to see massive interest rate declines over the board that is going to materially improve the situation for this company. And as a result, we might be looking at a, permanent valuation decline or multiple that the market is willing to give a company like BCE. Now, the Bank of Canada is in a particularly tricky situation because the economy here in Canada is really struggling and interest rates do need to come down. Now, that's an element of our particular mortgage structure where rental and mortgage costs are fueling inflation in a huge way right now, whereas in the United States, you can lock in a 30-year mortgage and your rate never increases. But the likelihood of interest rates coming down materially over the next few years are becoming less and less. And as BCE says, they do have some material debt refinancing coming within the next year. We're looking at the first quarter of 2025. And if rates don't come down, in 2025 materially or heading into 2026, all these higher rates are going to do is put more pressure on financing costs for a company like this, and it's going to make the environment much more difficult for them to operate. Ultimately, the dividend is not going to be covered in 2024. Whether that is the case in 2025 remains to be seen. I know a lot of people are thinking they're going to turn it around quite quickly in 2025, but I think that thesis relies a lot on a decline in policy rates, and that is far from guaranteed. I mean, we shouldn't be basing an investment thesis on policy rates. In my opinion, and I know a lot of investors are not going to like this, I think this company would be better off cutting the dividend. Then again, I don't think it's going to. I think they're going to do anything to keep that dividend maintained, even if it requires, getting funding, getting capital from elsewhere to maintain it. As I talked about, $3.99 in dividends. And we could see sub $3 earnings, and we're talking a big shortfall in terms of free cash flow, in terms of coverage. And overall, I really think this should be a bit of a Band-Aid scenario. Just get it over with, restructure the company, get, more back on track financially in terms of coverage ratios. But ultimately, I don't think they're going to do it. But that's just my opinion, my prediction. I do not think the dividend will be cut. Is the dividend in bad shape? Yes. It's very obvious. I hope I've highlighted that in this video. Next to no growth next year from BCE, cash flow declines. It's a rough situation for the company, and as a result, the market is pricing in, a pretty rough period for the next few years for BCE. So overall, everybody, I really hope you liked the video. I haven't talked on a stock in quite some time. I probably wouldn't go this in depth on future stock videos. I think this is one that does require a bit more of an overlook just because of the current situation. But if you like the video, smash that like button, head down below and comment. Not to mention, we give away free premium subscriptions to those who comment, but it really helps me understand if you like videos like this, or if you want to see me focus more on, maybe quick overlooks, more ETFs, things like that. And as always, head down below, 2x a week newsletter, the No BS newsletter. We're sending out amazing content to over 25,000 Canadians every single week, and you're not going to want to miss out on what we have moving forward. And as always, stay tuned for more great Canadian videos.